it's going to be a great opportunity at some point when it starts to break out to get long again. And then I think we're going to see it go and have a huge move. Also, we could see gold start to move up and start to build a bull flag and a launch pad and really start to break out and have another huge run and maybe go for one final blow off move. And maybe we see $7,000 or $8,000 gold. If this is the case, our strategy will say, okay, it's time to get back in. This wants to go for another run. Let's hop on and ride this bull even more.
What makes gold go higher? Inflation. Inflation is on the rise. Go oil or no oil, inflation is still on the rise. So that would be a big impetus for gold and silver to go higher. So I look for them to continue these rallies they're trying now. I think the lows for the period are in. I would not be surprised to see 6,000 or more in gold, and I would not be surprised to see silver make new highs again this year.
With the current inflation rate and political climate, many analysts think gold will establish a new baseline price over $5,000 per ounce. But if conflicts calm down, gold's price may steady, and we may not see the steep price changes that we've experienced over the past decade. What gold's price will be in 2030 will depend on the monetary policies set by the Federal Reserve and other global central banks. Veteran technical analyst Chris Vermeulen and Todd Bubba Horwitz discuss various strategies across stocks, commodities, and precious metals. Chris Vermeulen explained that gold's recent rally aligns with rising global uncertainty, but the sharp upward move has entered a euphoric phase often seen near market tops. He notes that such conditions are typically followed by meaningful corrections. In his view, this would represent a normal and constructive reset rather than a breakdown, creating a more favorable entry point for the next phase of the trend. Moving forward, Vermeulen compares the current setup to the global financial crisis, where gold experienced a temporary pullback before launching into a much stronger rally. Concurrently, he believes gold could reach substantially higher levels over the long term, potentially exceeding $10,000, though he cautions that such outcomes may coincide with heightened economic and geopolitical stress. He emphasizes a disciplined approach to better capitalize on major market cycles. If you're ready for unfiltered truth and sharp market analysis, hit that subscribe button. Let's explore the latest insights from Chris Vermeulen and Todd Bubba Horwitz's recent interview.
Let's look at the zoom back on gold a little bit. So gold has been doing exactly what you'd expect it to do. It has been moving higher as fear and chaos continues to pick up speed. Really right around here is where we started to see precious metals explode. This was kind of July last year. It's when gold really started to become mainstream. We started to see everyone pile in. And, huge numbers were touted for where it's going. We ended up seeing this huge move. So I think this phase right here was a blow-off move. I mean, we exited our gold above 5,000. We closed out our physical gold position, moved aside. We had a short-term trades in there as well. We played a move right in here. We also played another move right in here. On top of our physical gold positions, we just wanted to take advantage of these emotional mass psychology euphoric phases. So this euphoric phase typically gets wiped out very quickly. If we go and we look at this chart that I've shared with you before, this is the euphoric phase right at the top here where things just kind of go explosive. Everybody thinks they're going to be rich. Everybody's a genius. Gold's the best play, and usually that's when you see a huge correction. It stutters for a while, and then it falls out of favor. And I've seen this cycle rinse and repeat many, many times in all different asset classes over the last 26 years that I've been trading. And so we've got this blow-off phase. Now, if we were to zoom in on the chart of gold a little bit here and use Fibonacci extensions based on this most recent move, I find this is the most powerful tool. It's very accurate in telling you where price is most likely to go. So based on this chart of gold saying, okay, it's sold off down to here, it's rebounded back to here. Based on that drop and that bounce, it is telling us that gold should go to about 4,000 and then about 3,500, which if you look also happens to be the point where the switch flipped, where the mass psychology and FOMO kicked in and everyone had to get involved. And so the market is very good at anybody who chased price up in the last, final hours are going to pay the premium and more or less not only give back their gains, but they're actually going to go into a deep loss. So, I mean, where gold is right now, I think we could see about a 25% correction from where it is. And I see this as a huge opportunity. I think if gold pulls back here, that also means the equities market is crashing. I think it's going to be an unbelievable opportunity to reload in gold from where we exited with our strategy, which was to get out right up into this area over here. Being nothing like being able to buy it back at a huge discount and then ride the next wave. Because I do think eventually, in several years from now, potentially, we're going to see gold at 8,000, 12,000 and beyond. I'm a gold bug. I think it's very good, but I also can get rid of it when I think things are a little overdone and it's going to need some type of correction. And so that's kind of my view on gold. Now, silver is very similar, but before we jump over to the silver chart, I just want to kind of show my downside potential is about 3,500 for gold. That may take 3 months. That could take 12 months. Who knows? It might take a long time to unwind. If the stock market rolls over and sells off for 6, 8, 12 months, we could see gold slowly drift down and sell off. And I don't want to waste that time. I'd rather benefit from inverse ETFs. If the market's falling, I want to benefit from falling pricing. I don't want to just give back 40, 50% of my gains in gold and then wait years. I want to rebuy it at a cheaper price. So that's my bearish outtake. The bullish outcome here is we do have this big move up. It is putting in this giant bull flag. And whether it continues to flag out here and potentially come down even further, it's going to be a great opportunity at some point when it starts to break out to get long again. And then I think we're going to see it go and have a huge move. Also, we could see gold start to move up and start to build a bull flag and a launch pad and really start to break out and have another huge run and maybe go for one final blow off move. And maybe we see $7,000 or $8,000 gold. If this is the case, our strategy will say, okay, it's time to get back in. This wants to go for another run. Let's hop on and ride this bull even more. And so I don't really care what it does. I just don't want to be stuck holding something for 1, 2, or 3 years with no return. And to watch, 30, 40% of my gains or potential upside get wiped out when there's no need to, because we can follow price. So that's my take for gold is we just have to wait and see. The easy money has been made. Now we're waiting for the next setup. And, when we got into gold, I only trade precious metals with these massive kind of super cycles. And so the last time we got into gold was right over here. 2019 is when it broke out of this base. This is kind of what the dollar is doing. It's built this, this flat level, this rounding base. That's what precious metals did. And then we also accumulated more on the COVID crash right here. And then we sold like right up here. And so I'm waiting for this next reset. And I don't know if it's going to take 3 months or if it's going to take 3 years or 10 years like last time or even longer. So that's kind of what I'm looking for in my focus on trading precious metals. I don't want to ride this roller coaster when there is absolutely no need to if you understand how to read charts and sentiment and manage a portfolio. So we could see something like this. So this is the 2008 peak right over here in gold. We did see gold have a correction. It pulled back 34% from the high. And then from there, it was fairly short-lived. I think it was only like 8 or 9 months or so. And then suddenly it took off and it had that second big move. That's what I kind of feel like is going to happen here. I think we're going to see gold and things pull back. And then we're going to see it like ramp up and go absolutely ballistic for many years. I think it's going to get stretched out even further. And I think we'll be up in the teens, right? Like, 13, 14,000 for gold, something like that. When you look forward 5, 10 years from now, it'll be a great value. That's ideally in a way, that's what I'd like, because then we can get some very big returns quickly. My only concern is like looking at it from, if we have $10,000 and $15,000 gold, I mean, man, it really worries me what the world will be like, right? It could be real ugly. There could be a lot of war. There could be a lot of robbery and theft and all kinds of stuff. This is high gold prices we don't really want, because it just means we're living in a more uncertain, a very higher risk kind of environment. So in a perfect world, gold goes dormant and does this for the next 14 years, and the world stabilizes and the market has a little reset, and then we start a new bull market and all of that. But if gold keeps screaming and silver takes off to 200 and change plus, it might not be the most exciting life that we're living, right? Like I just renewed my gun license. I haven't used it in over 10 years. And I'm like, I'm renewing my gun license and I'm just getting prepared. I think when push comes to shove, if all hell breaks loose, you need precious metals, physical, because internet could go down, or who knows, or AI is controlling everything. Once AI takes over and can hack every system, we're really screwed. And I think it comes down to like physical metals. Crypto will be worthless if like the internet's hacked by AI that's like done it all, right? So you need physical metals, you need food and water, and you need bullets.
In his analysis, seasoned investor Todd Bubba Horwitz explains that gold continues to show underlying strength despite recent volatility, and he anticipates prices could move toward the $6,000 level. He notes that current market conditions are unusually thin in volume, suggesting that institutional investors are largely inactive while retail participants drive equities higher. In his view, this imbalance creates a vulnerable market structure where stocks may be advancing without solid backing, increasing the likelihood of a sharp downturn once larger players step in to sell. Todd further emphasizes that inflationary pressures remain a major tailwind for precious metals, supporting both gold and silver over the longer term. According to him, recent declines in gold were not driven by weakening fundamentals, but by liquidity stress, as investors sold positions to offset losses in other assets. This view aligns with recent market developments, where rising bond yields, persistent inflation concerns, and mixed corporate earnings have kept uncertainty elevated. At the same time, reports of continued central bank gold purchases and cautious outlooks from major financial institutions reinforce the idea that precious metals remain a key hedge, even as equity markets appear temporarily resilient. Let's jump into the interview.
Gold's going to go higher, and gold's going to hit our $6,000 target this year.
Wow.
I think you've watched a market in general that is lacking volume. All markets, we're down about 40% of normal volume right now. You've got the equities charging higher. I still believe there's a substantial sell-off coming. It doesn't have to be, again, I can't time that. That would be foolish of me. We've made new highs this week in the S&P and in the NASDAQ. So we'll see how that plays out. Oil has already tested this week back into the 80s. Okay. So again, on Wednesday, it printed $86. I think oil's going back into the 50s. I think once this whole Middle East mess is over with, I think the fear premium's coming out. But when we come to the metals, they couldn't look better. They had a big sell-off, and actually gold printed 4,100 a couple of weeks ago. But at the end of the day, I thought that was great action, and especially if you want to be a buyer, because we are in consolidation, and it looks like we're trying to break to the upper end, which would fuel the rally. Add into that, what makes gold go higher? Inflation. Inflation is on the rise. Go oil or no oil, inflation is still on the rise. So that would be a big impetus for gold and silver to go higher. So I look for them to continue these rallies they're trying now. I think the lows for the period are in. I would not be surprised to see 6,000 or more in gold, and I would not be surprised to see silver make new highs again this year. Well, you know what? I'm going to put it this way. I think that this is a market we call this a retail market right now. The markets are predisposed to go up. They've gone up in history 8.5% year over year and 10% year over year since 1950. Okay, so they go up every year, year over year. I think this is a total retail rally, and how do I say that? Well, look at the volume. Volume is down 40%, which means the big players, JP Morgan, Goldman Sachs, Citi, they're not playing this market right now. Their regular investors are long. And of course, that's what we expect. You see pension money rolling every day, 401k money rolling every day. So that is the impetus to push these markets higher. But they're going up with no force. I personally believe, and I can't prove it, and I'm not going to say that this is a fact, but I personally believe that the big banks, the big traders, the big funds are waiting to sell. They're letting the retail exhaust themselves here on this rally. And I think they're going to come in, and they're going to come in hard, because there are so many warning signs in this market that should scare you.
Like what?
Well, first of all, the BlackRock no redemptions. That's number one. That also indicates that banks are in a little bit of trouble. The default on cars, the default on mortgages. Their interest rates are rising. If you go back, the Fed has cut rates 300 basis points. The 10-year notes have gone up 400 basis points. So where is the benefit for the consumer? We're losing jobs at record paces right now, and those jobs are never coming back. those are being replaced by AI. So all these little things that we ignore and that the average investor ignores until it's too late. And then they panic and say, oh, I got to get out. And I think that was one of the reasons when the markets were selling off a couple of weeks ago and gold hit 4,100, I think that was people taking their money out of gold to try to support their equity positions because they were over leveraged. We had the initial reaction, okay, to the market, and then it came back. And of course, the markets are now rallying. And gold is rallying. Listen, it was 4,100. It's now 4,800, 4,900. I mean, it's still on its way back up. Markets pre-advanced the war. This war has been going on, what now, for a month? So if you go back and look, equities were lower. Now the news, it's now become old news, okay? And companies are still performing. We're right in the middle of earnings season again now. And so far, the big reporters so far have done well. Their stocks have not performed necessarily great, but certainly JP Morgan and Goldman Sachs beat on their earnings. But markets had already assumed what was going to happen. And now the markets are saying that there's not going to be any more problems. Now, is that a fact? We'll see. I think that there's a lot of issues to worry about. And I think the war is way in the background of where the real problems are going to come from. The war action was just that, a reaction. And when you look at crude oil, and that's your best benchmark to watch when you see something in the market. At one time, crude oil was trading at 110. December crude oil was trading at $70. That means there was a $40 fear premium in oil. Okay. That's telling you that this is all going to end real quick. And only the fear drivers were driving up the price of oil. And we've already seen oil come down 20, 25% from its initial rally. And I believe there's a lot more because in the United States, we have a glut of oil and we have all we can handle and more. And we could supply all the nations that were needed. And the Straits of Hormuz, listen, only 2% of the world's oil flows through there anyways.
Historically, gold prices have been stable or have even increased steadily. But recent economic changes and geopolitical tensions have made its price more volatile. Although gold analysts are optimistic about gold's future, the market is volatile right now, so gold's price may fluctuate significantly over the next few months. Short-term price dips are likely, but over the long term, gold has historically performed well. Gold could hypothetically reach $10,000 within the next decade, but such a high price would require significant changes. High inflation rates, economic uncertainty, and currency devaluations could help push gold's price higher. If gold is entering a phase of both euphoric peaks and sharp corrections, are investors better off waiting for deeper pullbacks or continuing to accumulate gradually during uncertainty? Let us know what you think in the comments. If this video brought you any knowledge, give it a like, subscribe, and ring that bell so you're always in the loop. See you in the next video.